Hi everyone, it's Chap out with another video. Today I'm going to be talking about 3 Dividend Aristocrats that I think are trading really nice valuations right now, all 3 near the 52-week lows. Dividend Aristocrats traditionally do well in times of recession, in times of market crashes. The 1-year return for the S&P 500 Dividend Aristocrats Index is minus 8.81% versus the S&P 500 returns of 11% in that same time period. This is not including dividends. So the Dividend Aristocrats have a higher yield than the S&P 500 average, so that is additionally even stronger. This inherent strength in tough times only adds to the allure of the Dividend Aristocrats. Dividend companies that grow the earnings consistently, grow the dividends consistently, and reward shareholders well. These are my favourite 3 at the minute, all near the 52-week lows, that remain great businesses with fantastic long-term prospects and, importantly, really strong dividend histories. The first one is probably the most well known. It's Procter & Gamble. I believe it's the second largest dividend aristocrat by market cap. It's the owner of many brands, multi-billion-dollar brands: Gillette, Pampers, Always, Ariel, Bold, Furry, Tide. Depending on what territory you're in, there's tons and tons more. Many multi-billion-dollar brands. Fantastic company that has a tremendous dividend history. Company stock price today is $136. That's down from a 52-week high of $165. Near the 52-week low of 129. Procter & Gamble hasn't really done that much this year. Price to earnings ratio has compressed slightly over time at 23, still above the S&P 500 average, but seems reasonable at this rate. Dividend yield of 2.68% right now, at a market cap of $327 billion. The dividend yield on a forward basis is actually slightly higher at 2.76%, has a 60.72% payout ratio. Bear in mind, free cash flow is a little bit depressed this year, partly due to the wider supply chain crunch, which a company like Procter & Gamble, which is a very supply chain intensive, is feeling the pinch a little bit. They have a 5-year dividend growth rate of about 5.48% and 65 years of dividend growth. So this is not just a dividend aristocrat, but a dividend king. You can see over the last 10 years, revenue hasn't really done much, growing at an average rate of 0.1% over those 10 years. But over the past 5 and 1 years, we're at much better numbers, 4.9% revenue growth over the past 5 years, and it's performed decently in that time frame. Free cash flow has grew on average, in contrast, 5.7% over the last 10 years on average, 9.6% over the last 5 years, and that is with the company decreasing its free cash flow by an eighth, down 12.5% this year, again due to that supply chain crunch, which I do not think will affect it in the long term. So I'm very happy with the long-term prospects of this business. Consumer goods companies like this typically do very well in times of recession, inflation, because people are just not willing to part with certain brands. You will always get Gillette razors. For some people may always get Gillette razors, may always get Pampers diapers, blah blah blah. People have a lot of brand loyalty, there's a lot of brand equity there, and they're quality products that people go back to, and there's a degree of pricing power there. Valuation wise, this is inarguably the most expensive of the 3. For a P ratio on a forward basis of 22, price free cash flow of 25. This is not screaming cheap by any means. This is a decent price to get Procter & Gamble for versus historical valuation, particularly on PEG ratio basis, whereas PEG ratio is 5, which is by no means cheap at all. Definitely not in the 1 to 2 area that I would prefer, but a 5 is very good for Procter & Gamble because this business trades at such a high premium. Very rarely will the P ratio of this company dip below 20. Very rarely will it dip below 15. There is never really that bad of a time to buy Procter & Gamble. Over the last few years, the trailing P ratio has been well into the 30s, sometimes 40s, so I believe this is a reasonable time to get in. By no means screaming cheap, but a decent position. I don't think this company is going to drop much lower in the near future because this is held at such a premium. Next company on the list is 3M, and you can see a theme developing here. Diversity of revenue. 3M, like Procter & Gamble, is in many different business areas, different segments of the market, and is extremely well diversified. Its revenue is extremely robust and can withstand many different market conditions. Again, tons of different brands: Scotch-Brite, Scotch, Post-it, Command, you name it. This is a company that is in a lot of different fields, and that shows by very little reduction of revenue when times get tough. Around this time last year, 3M was trading for $195, which I believe was slightly inflated. It's a 52-week high of 200, which would give it a P ratio of in the region of 20, which I believe is a little inflated for this company's revenue and free cash flow growth. It trades at $130 now, which is just above its 52-week low of $128. At this price, it has a market cap of around $74 billion, which I think is far too low for this company. Its dividend yield on a forward basis is 4.59%, a 59.3% payout ratio, so like Procter & Gamble in that 60% range, which is not ideal. I would prefer to see this below 50%, but it's completely achievable based on the free cash flow of this company. 5-year growth rate of 5.38%, which is again strong, and again, another dividend king, 63 years of dividend growth. That is really, really impressive. Revenue, a bit better than Procter & Gamble, up 3.6% on average over the last 10 years, similar for the 5-year rate, and in the last year it went up, could double what it normally does at 7.4%. Free cash flow, again, rising dramatically, much dramatically higher than revenue, 7%, 6%, and over the last 10 and 5 years. In the last year, it went down nearly 30%. Again, supply chain crunches have really hurt this business, much like Procter & Gamble, but to a much greater extent. The pandemic also wasn't that helpful for this company. While you would think that they're selling masks and blah, 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 as all the personal protective equipment, this is really a fraction of 3M's revenue, and a lot of its revenue was hurt, and a lot of the production was in China, which is seeing frequent shutdowns at the minute. So 30% free cash flow is kind of an expected loss, but they're maintaining revenue, and this will bounce back immediately. You got to remember, even for these dividend kings that are frequently raising the dividends and withstanding all market conditions, they are not immune to some short-term pain, but they always bounce back, and I believe the 3M will do that in the very near future. Valuation-wise, I think the valuation is much more reasonable than Procter & Gamble here. P ratio of 13.53 on a trailing basis, very, very strong for 3M's history, some of the lowest you'll have seen. Per forward basis, a 12, again, some of the lowest you'll have seen, and below the S&P 500 averages at the minute. The forward P of the S&P 500 is around 15 at the minute, so there's a decent discount to that. Price free cash flow of 15, not super cheap for the wider manufacturing industry, but very, very cheap for 3M's history. You got to remember, this is a company with 60 plus years of compounding its dividend. Those companies are rare, and those companies trade at a premium, and 3M normally trades at a premium, and the stock has been hit quite badly this year, and I think this presents a nice buying opportunity to get this company a fraction of the price it normally trades at. The final company, and easily the least well known, some may not even know the logo, is T. Rowe Price, an investment management company with well over $1.5 trillion in assets under management, and is consistently ranked in the world's top money managers worldwide. This is a company that knows how to deal with its investments, knows how to allocate its capital correctly, and is frequently rewarded even in times of wider financial hardship. T. Rowe Price, like many companies in the wider margin, has took a massive hit this year, down 44% in the past year. Its yearly highs of $224, now $109, $110, for a 52-week low of $104, so slightly above that 52-week low. P ratio very depressed here, market cap now under $25 billion for a company with $1.5 trillion in assets under management, growing revenue at an excellent rate, growing free cash flow at an excellent rate. This seems a very irrational decline in my opinion. When it was at $200, it was far above its historical averages for price to earnings ratio, so I can see why there's been some decline because it looked slightly overvalued, but even still this looks like a strange large decline. Looking first at the dividend statistics, another strong yield, 4.5%, far above the S&P 500 average. Payout ratio of just shy of 36%, well under the 50% that I like to see, much better than the other two companies. We have got to bear in mind, T. Rowe Price, its free cash flow is going through the roof at the minute, whereas the other two companies, the free cash flow is depressed due to supply chain crunch, which I believe will be a very short-term issue, and they will bounce back soon. Has a 5-year dividend growth rate of 15.48%, which is truly impressive, and 36 years of consecutive dividend growth, making this not a dividend king, but a dividend aristocrat. It grew its revenue at 11.5% compound annual growth rate over the last 10 years, 13.2% over the last 5 years, and it grew 17.7% last year. Very, very impressive. Free cash flow, on the other hand, has grew slightly below that, 8.1% on a compound annual growth rate over the last 10 years. Last 5 years, it's up 183.2%. In the last year alone, it was up 75%. This is a company that is really firing on all cylinders, hence the incredible growth rate of its dividend, hence the low payout ratio. It's a company that is really doing well. Everything's doing well apart from the stock price. Looking at some basic valuation metrics, you can see on the right hand side, this chart is from GuruFocus.com if you're interested. On the right hand side versus history, pretty much everything fully in the dark green. These are some of the best historical comparisons you will ever see for T. Rowe Price. It's looking about the cheapest it's ever looked in its history. a PEG ratio that's jumping off the screen to me of 0.57. Very, very cheap for any company, in that bargain territory of under 1 that the likes of Peter Lynch looked for. Just about the cheapest you'll have ever seen in T. Rowe Price history. Price to earnings ratio on a trailing basis of 8.88 and a full basis of 10. Both far below the S&P 500 averages, meaning this is a company that is trading at a significant discount to the average S&P 500 company. Price free cash flow 7.57. That really is bargain territory. Versus his history, this is about as cheap as T. Rowe Price has ever been, and it's very, very strong for the financial services industry. Overall, I think this company has been severely undervalued. It's not really experiencing any of the hardship the other two companies are, and this looks like the one that is most obviously cheap right now. Of course, all three are trading at 52-week lows. These companies very rarely have precipitous declines unless there's some systemic problem with the company, something inherently wrong with them, which it's not. In the case of Procter & Gamble and 3M, they're both suffering in the short term from supply chain crunches, and that will pass with time. If you ask me which one do I think is the best buy right now, I would say T. Rowe Price. It clearly looks like it has the best valuation. If you ask me which one do I think is the best company for now and forever, I would probably say Procter & Gamble, because that is my personal favourite. But I think the one that is the most obvious buy based on its fundamental metrics right now is T. Rowe Price. Of course, none of this is financial advice. You should do your own research and due diligence, and let me know when you've done it in the comments below. Tell me what you think about these three companies. Tell me what you think about the wider Dividend Aristocrat index, which ones you think are buys, which ones you think are sells, blah blah. If you enjoy the content, like and subscribe. Let me know what you think in the comments. I'll see you again next time.